Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 138 of the PetroNerds podcast. My name is Trisha Curtis. I'm the CEO of PetroNerds and the host of the PetroNerds podcast, and I have an absolute special treat for you today. This podcast, episode 138, is a conversation and sit down with the CEO of Liberty Energy, Ron Gusek. So today is August 14th, 2025. I'm going to keep this introduction very short because this is a lengthy and very timely conversation I had with Ron Gusek. It's an hour and a half long, and it's worth every minute, folks. You're going to want to listen to this, and you're going to want to share it with your colleagues and your friends and your family. But today is August 14th, 2025. Right now, we are seeing oil prices at $63.89. We are looking at Brent at $66.80. We actually just touched 62 handle the other day. We're seeing Henry Hub under $3, $2.84, which is important to keep in mind in the context of this conversation I'm having with Ron. And actually, if you were listening to all the earnings calls for service providers, you would have heard a lot of talk about natural gas. Dutch TTF is $11.11 right now, European natural gas prices. And we're seeing the 10-year yield at 4.279, folks. We're seeing the 30-year mortgage just under 7%, 6.67%. There's a lot going on in the stock market and in the economy and in oil prices. I'm not going to spend a lot of time on that because I really want to spend the time just talking about service companies and talking about Liberty and really what you heard, the major theme coming out of most of these service companies over this past earnings call. So this conversation and this sit down I did with Ron Gusek was on July 2nd, 2025. Now, their earnings call dropped on July 25th, and you're going to hear, if you listen to their earnings call or read their earnings call, you're going to hear a much deeper dive on a lot of very similar themes. So we cover everything from their assets in the Beetaloo, or what they're doing in the Beetaloo in Australia, what they have done, what they look forward to in Australia, to everything going on in the power sector and everything in between. And really, most importantly, I wanted to spend time with Ron talking about the state of the oil and gas industry. Thinking about, at the time we were recording, oil prices, WTI was $67.25 on July 2nd, and it had just seen a little pop because Iran had suspended cooperation with the UN nuclear watchdog, the oversight. So that wasn't shocking, but it did drive prices a smidge higher. And, really what we've seen over the past 2 months is a lot of that price volatility, where we see prices go up to 70 and we see them come back down, and seeing prices go back down to $63 a barrel or $62 a barrel, as they did just the other day, or as they have done just the other day, and seeing the $63 and this really $7 pullback we've seen in less than 2 weeks, or about 2 weeks. This is not really reflecting supply and demand reality. And this is stuff that Ron and I get into in this conversation. But as of right now, we're looking, and just to put this in perspective, because we talk about the rig count and the frac fleet count and just the state of the oil and gas industry, what is happening actually in the field right now, and the perspective. And Ron and I really discussed that we do think that it's a little overdone, right? The sentiment's overdone in terms of the everybody dropping the rigs and frac fleets. And the reason I'm going to say this now is because right now, the latest data, from August 8th from Baker Hughes, we were at 539 total rigs. And what we've seen, really interestingly enough, in the past few weeks is this move from the rigs from oil to the rigs to gas. So you've actually seen the rig count actually plateau, and you've seen just week over week a plateau in the oil rig count, but you're seeing oil rigs at 411 rigs, and you're seeing gas rigs at 123. They've moved up about 20 rigs. And so that's very interesting. And I think what you'll hear in the context of this conversation, and if you were listening to the earnings calls of the service companies, whether it's Liberty or Halliburton or ProFrac or others, you do hear this talk about natural gas. And many of them echo what Liberty's talking about. What you're going to hear within this conversation is this talk about, a more bullish feeling around natural gas, a little greater exposure to natural gas, as well as everything going on in the power sector and the demand there. So we're also looking at, in comparison to this conversation, which we had on July 2nd, we've had a notable drop in the frac fleet count. So according to Primary Vision, and this is something we discussed in this conversation as well, is that the horsepower is very different, right? The rig or the frac fleet count that we had a few years ago is a lot different than the frac fleet count we have now. And even now, I think you have to be quite careful of the frac fleet count, because we have a lot of horsepower. And as Liberty mentions in the earnings call, they are doing a lot of simul-fracs. And so it's the thinking about one frac fleet might be doing more than just a one frac fleet for a given company. So 163 frac fleets is where we're at right now, or according to Primary Vision as of August 8th. But when we were recording, The frac spread count was 182. And it's important to note because I literally just heard Brian O'Sullivan on CNBC today talking about the frac fleet count or the frac spread and saying that production was going to go down. And this is relevant in the context of what we've seen in the past couple of weeks of what's driving prices, this volatility in prices is we did have OPEC come out with another increase in output, well over 500,000 barrels per day. Again, I've talked about this at length before. Most of this is going to the Saudis. They're taking back market share. But we also see, in addition to that, we have this meeting between Trump and Putin that's happening tomorrow in Alaska. And I think you've heard a little bit of the Trump administration, at least the press secretary, walking back kind of the optimism on this meeting, essentially saying this is the first meeting. This is not a trilateral meeting. This is a bilateral meeting between the Trump administration and Putin to essentially just see what's going on. Now, we have seen a lot of activity. I mean, this is an ongoing war in Ukraine. So we have seen a continual amount of bombing and drone attacks and missile attacks. And if you're actually charting this, you're seeing a real escalation and ramp up of what's going on within Ukraine. So that's ongoing. And so when we see this drop in oil prices, yes, it's reflecting optimism and a sentiment that potentially we'll have a deal. And that's when we saw prices come down. But it's also just, it's trading volatility. It's algorithmic trading. And it's a lot of sentiment, and quick click on the sell button. It's not necessarily reflecting reality. And so I do feel like when you're listening to these earnings calls, and I did go through Liberty's and Halliburton's ProFrac and most of Baker Hughes in their second quarter 2025 earnings calls, and you're hearing this theme where I thought Liberty, echoes a lot of what we talk about in this conversation with Ron. But he also talks about other things, right? Where they're actually at. All of them essentially mention white space on the calendar in the second half of the year. Now that's not good. And I think when you're listening to ProFrac, you're hearing, hey, we added frac fleets, but we have white space. And that's essentially telling you they are looking at market share, right? Whereas Halliburton and Liberty are saying they're not necessarily looking at that, right? They are maintaining they're looking at their core clients, they're maintaining activity to the level that they are. And you will hear Ron Gusek talk about in this podcast, and you hear him a little bit as well within the second quarter earnings call, is talking about the exposure on natural gas. And that I think is really, really interesting, folks, because I don't think anyone had in their bingo card, this resiliency in natural gas, actually moving rigs to natural gas at $3 an MCF gas. Now, I think that's important because I think it really tells you of how bad it was in 2024 when we had $2 flat natural gas prices. And so we didn't have any of that passed along to the consumer. We certainly didn't see that in residential natural gas prices. In fact, we've continued to see electricity prices go up. We've continued to see utility companies really stick it to the consumer and increase the prices for natural gas as well, which they should not be doing. But we now have sub $3 natural gas, and we're still adding the rig count. So we are seeing well over 130 BCF a day in gross withdrawals for U.S. natural gas production. But what we're seeing is this momentum and this drive, right? In addition to what all these companies are talking about and what Liberty talks about at length within this conversation with Ron, is power, right? It's the power generation side, the fact that what they're doing on the power side. Since we had this conversation and around the earnings call, they talked about Oklo as well. So when we talk about this at length of what's going on the power gen side. So we know that the utilities are not keeping up, right? We know that we are decommissioning coal-fired power generation. We actually have less coal-fired power generation in our grid now than we do wind and solar. And that is really putting pressure on prices. But the reality is it's also making power unreliable. And that's not what you're seeing overwhelmingly in all these calls. But I do think Ron Gusek, he closes with that a little bit in some of his earnings calls. And he talks about it within this podcast as well. So there's a lot on the power side, and there's a lot coming out of the administration, whether it's increasing LNG exports, whether it's tying energy purchases, particularly likely LNG purchases with the European Union and their tariff rates and cutting these deals. And most importantly, whether it's the lifting the ban on LNG exports and the demand for AI and all these AI facilities and these data centers that are needing this power generation demand. And so when you listen to the earnings calls, that's what you're hearing is these deals that are being set to actually, to lock in with power generation demand for natural gas. And so that's telling you that the grid is not providing that, and that costs are high, and that's a lot of this together collectively is providing that momentum for natural gas. And I would also be remiss to say one of the biggest takeaways, listening to Ron Gusek, being exceptionally kind and thorough, and to sit down with me, I cannot thank him enough. He is absolutely one of the best guests I've had on the podcast, and it was just a true treat and delight to sit down with him. But he did a really good job of helping to talk about the state of the industry, and I wanted to spend some time and emphasize this point because I do think at the time, I thought it was overdone, and I still think it is overdone. At $62 a barrel, when I saw 70, there's a lot of folks that are profitable in the 60s. And so it's hard when you're talking to operators. When I'm talking to operators and CEOs, I don't hear the same thing across the board where everybody is sort of cutting and running. And I do think when we're thinking about the state of the industry and the state of the frac industry and what it looks like going forward, you hear a different thing across the board for all these companies. You hear about the white space, but you also hear about, what's going on within the space, right? That we are going to have attrition in the actual components, right? That we're going to have attrition on the frac fleet side because you're going to retire some of your equipment and you're going to run better equipment so that you can get better margins for your operators so that you can reduce the cost per barrel or the cost per MCF to get out of the ground. And I do think that's what we're seeing, particularly with natural gas, is that, when you're at above $3 an MCF gas, there's a lot of momentum there that we have very, very cheap natural gas in the US. And that's the one thing I feel like is being quite disconnected at what we're hearing overwhelmingly in the market. And the comment that Brian O'Sullivan made was that, hey, the frac fleet count is down and we're going to start losing production in the US. Yes, we're going to lose production in the US when we drop the rig count, when we drop the frac fleet. But you have to meaningfully drop the actual wells being completed and brought onto production and sustain that drop in order to really, really drop output. So now is when people are starting to say, okay, EIA is saying that we are going to peak output at the end of this year. That was when we'll see peak. We probably actually peaked or this year, given the activity that we're going to see a drop off, probably this 13.5 million barrels a day that we're around. And maybe we maintain that for a little bit and grind higher or maintain this. And I think people have been actually surprised that month over month, we continue to see this 13.5 million barrels per day, even though we're drilling less wells. Well, we're drilling less wells, they're longer laterals. There's a lot of efficiency gains. And what the frac industry is doing, what the service sector doing is so impressive. And I think that's really important to think in the context when you listen to this conversation with Ron is what about the evolution of Andy of the market, right? What's going to happen in these levels of play of the state of the U.S. oil and gas space? And what I say is important to think about this is everyone is sort of counting oil down and out, and it's very disconnected from the economy and the stock market, right? The oil prices being as low as they are telling you that we have a lot of supply in the market. We don't have a lot of momentum in economic growth and demand growth, certainly seeing really bad data out of China. And then, but on the natural gas side, we have 398 billion cubic feet per day of global natural gas demand. That's what it was as of 2024. That is incrementally rising each year. And so we know there's a lot of opportunity and a lot of market share for that. But in the US, these things are together, right? We have now in the Permian, we have associated natural gas and we need to have lots of takeaway capacity. And you have to process it and you have to do something with it. But in places like the Haynesville and now increasingly in the Eagle Ford, it's getting really, really sexy and really appealing because the break evens are so low. And something you also hear in the Liberty earnings call and a little bit less within this podcast, but is the exposure on natural gas in the Haynesville. I think Ron talks about it in their earnings calls that it's a high pressured, high intensity job. And so it has a lot of wear and tear on equipment. And that matters a lot for the type of equipment you have. So if you think this industry is boring, it is anything but boring. And I love completions. I love the frac space. I love, just thinking about pumping 3,000 pounds of sand per lateral foot. And on average, looking at 3, 4, 5 mile long laterals now, as long as 5 mile long laterals and getting production. And that is part of why I just really can't underscore enough, folks, is that is why we're seeing production maintained. The levels of production, at least through May, were maintained. Now we are going to see that start to drop off, but that does not mean that is indeed peak shale. In fact, just like COVID, when that dropped, it can probably come back. And I would wager that it can come back in multiple different fashions. And I do not think you need, I don't think you need 75 or 8, I don't think you need $85 oil. Certainly if you get 70 and you stay there, you're going to have opportunity for some material uptick. And you did hear in some other earnings calls on the service sector side as well, is the optimism seeing around 2026. And so that also means that what you're going to see is that folks are probably going to adapt to this, right? If we stay in the 60 to 70 range, oil and natural gas companies are going to adapt and they're going to kind of continue to grind forward. And that does have implications for the equipment and for the service sector. So with that, folks, I cannot say thank you enough to Liberty Energy and thank you enough to Ron for sitting down and doing this podcast. I really can't wait for the reviews for this, folks. So thank you so much to Liberty. Thank you to Ron. And thank you guys so much for listening. Talk to you soon, folks. Bye. Hi, Ron.
Hello.
Nice to see you.
Great to see you.
Yeah, so this is your first time on the PetroNerds podcast.
First time. Looking forward to it.
Welcome to the PetroNerds podcast. So we are in Liberty's office in this pretty cool, I don't know, is this your podcast space?
It is. We film a number of videos here, training videos and things like that, podcasts, whatever we might be working on that day.
Yeah, so it's awesome because I fiddled around and moved lighting, and so this is really cool. So I might ask to use this space again.
All right, that's what it's here for.
This is very cool. So Ron Gusek, you are the new CEO of Liberty, but you've been with Liberty basically from the beginning, and you were the former president. So this is new, but this isn't really new.
No, obviously Chris and I, first of all, have been business partners and friends for more than 20 years now. Since 2003, I think, was when I first crossed paths with him. And so I had the chance to be part of his first company, Pinnacle. We worked alongside each other there. I ran the Canadian division. And then once we got Liberty up and running, I packed my family up and moved south from Calgary to Denver, and been here since the start of 14. So have enjoyed being part of the family, so to speak, for quite a number of years now, and certainly at Liberty for now 11 of those.
That's awesome. And it is an awesome family. And it's funny because I was going through your earnings calls, and you guys had mentioned at one point, somebody was talking about just the quality and the desire of people to want to work here, and that you have way more applicants than you have jobs. And it's something like, it's a testament to this of being in Denver and starting up PetroNerds in 2016. It was all people talked about, right? It's like, it is a very coveted job. So that's a really awesome thing that, Liberty is where you want to work in Denver, and I guess across the country.
Yeah, and it's a privilege to be a part of it, of course. I would have said, there aren't many people I'd have packed my family up and moved to another country for, but Chris was one of those people. Yep. He has that passion and creates that sort of environment, a place you want to go and be a part of. And so I'm thrilled to be here, and so excited to see what the past has held and what the future yet is yet to bring.
Yeah, well, we are going to get into that. So,
all right.
So this is the PetroNerds podcast. No clue what number this is. We'll do that later. But it is Wednesday, July 2nd, 2025. And it's a great day to do this because we will touch on Chris Wright as the Secretary of Energy, but this is about you. And this podcast is about Ron Gusek and Liberty and what you were doing. And I'm pretty excited about it because your earnings calls, you've been knocking them out of the park. They're just, you guys give such a overview of the market, and I think listeners, we're going to dive into a lot of that today. But right now we're at $67.25 for oil prices, and we were kind of hanging in to 65. There's a lot that's happened in the past few weeks. We're at Brent to 69.93. Henry Hub is $3.48. The reason we're seeing this uptick in oil prices, and this is just important to note for the timing of this recording, is because we saw 65 literally yesterday, and we sort of held in this. And this was ahead of OPEC is going to meet this weekend. They've already told us they're going to increase output. They told us last month they were going to do that by probably 411,000 barrels per day, as they've been doing. And so now we're looking at okay, well, we knocked up $2, even though we're going to have this output increase. And that is really because Iran has suspended their cooperation with the UN watchdog, which is, I was so shocked about this. This is my shocked face. Oh my goodness, they're suspending this. So I've been kind of thinking for a while, yes, we have pressure on oil prices. I keep going back to this, where we were in December at $69 a barrel. And I was telling listeners and clients that, this is really kind of where we should be in terms of supply and demand. The economy's not ripping, no one's growing demand, and we have a lot of supply. And so 69 was kind of real. And no one wanted to really, I feel like no one wanted to really believe that. And now it feels it was pretty real. And now what we've had over the course of this year has been a lot of volatility and a lot of wonkiness. But we get these geopolitical price spikes, and then those get ripped out very, very quickly. And obviously that has, you have thoughts on this. We've talked about it a little bit, but would love to get your thoughts on the macro and just this volatility. And then of course we will dive into how this impacts Liberty.
All right. I think you hit all the highlights there. I don't disagree with any of the things you've indicated, which was that at a very high level, we have a question around supply and demand and how those two interplay with one another. And ultimately, that has crude oil prices, WTI, where they are. And that's the big picture situation. And I don't think anything that's happened of late has meaningfully changed that outlook. These are short-term issues that aren't probably in a position to change the supply-demand imbalance we expect towards the end of the year. So as you suggested, that was already a possibility at the start of last year. That's probably been cemented a bit by the trade negotiations that have been going on. We've probably tamped down economic growth a little bit globally this year. So that probably plays in a bit to demand growth and where that's going to come out. We've had OPEC Plus come out and say very, very clearly where they're going with supply. And, you could argue about what the numbers are going to be, but at the end of the day, we're probably 1 million barrels out of whack at the end of this year. We've had over the last couple of weeks some volatility that's played into that. But none of those things, I think, could meaningfully change that outcome. You could argue that Iran could have closed the Strait of Hormuz, but how long they could have sustained that for, I think it would be tough to say that could have gone on for any meaningful amount of time, and as a result, meaningfully changed our outlook for the back half of the year. And you saw WTI respond accordingly. It rocketed up there for a very short period of time, but it didn't take long for it to find its way back into the 60s, which is probably about where it belongs today. And so, I think despite these very short-term issues that have been moving price, at the end of the day, big picture supply and demand, macroeconomics is what's going to drive the price of crude. And so I think we are where we are. It's we'll talk about a bit later maybe what some of the implications of the past couple of weeks are and maybe what that's done. But at the end of the day, I still think we're in a situation where we're going to have a bit more oil than we have demand for that oil, at least for the next year or two.
Yep, and that's a great way to characterize it. And obviously, we don't know. I mean, if any of us knew it perfectly, would be
crystal ball is always pretty fuzzy.
Yeah, it's always pretty fuzzy. But I do think it's and I always remind people. I think that's you described it really well. Is that we can talk and prognosticate about it will be, but we can we can do right now is say, should we be here? Is this a right level? And I still think we're 67.25. We're not quite as oversold as we were. We're getting back into this. We probably should actually be between 65 and 70. But we're a little oversold still, 65. Like, there's no geopolitical risk premium, and we clearly have a lot of geopolitical risk. And so, I always think this for clients and folks like in the field, like, what does this mean? And I don't think this is quite as bad of a year as I hear from. We will get into this peat shale stuff and everything because, I go around and I talk to lots of CEOs and folks in the on the boardroom level and also just in the industry and in the field. And you were probably feeling that, at least maybe verbally, the kind of pessimism, particularly in April, but we saw it in March as well. And really when, people were questioning the administration on what does drill baby drill mean and what do they want for oil prices. So there was this, I thought there was a overwhelmingly amount of pessimism when we were at $69 a barrel. I thought that actually a couple years ago we were at 80 and the industry acted like we were at 60. But it was interesting in March, and then obviously April happened. And that pessimism is just interesting because I think, $67 a barrel is not pessimistic. It's not that pessimistic. It's not amazing. It's not, gun-ho. We are gonna rip and let's add rigs left, right, and center, or completions for that matter. But it's also not like devastating. And I don't think, this sell-off or this rig count, what we've seen drop to 554 now, I don't think we should be seeing material 5-10 rigs drop off every week at $67 oil.
I don't disagree, and certainly I think we've had a little bit of clarity added to that over the last few months now around just what that number means. Like, if we have WTI in the 60s, what are the actual implications to our customers on the E&P side? And I think you've heard a number of them, particularly the publics now, stand up and say, look, we're economic in the 60s. Yes, this is maybe eating into our free cash flow a little bit, and so our return of cash to shareholders is modestly impacted by this, but by no means are we underwater with the drilling of a well. And it depends operator by operator, but you'll hear operators talking about numbers in the 40s, maybe into the 50s, but 60-something dollar oil still has them in a spot where returns are not unreasonable by any stretch of the imagination, particularly as costs have come down. We're in an environment where we've got excess rig supply and excess frac count supply, and so we've seen pricing move as a result of that. They've, maybe there has been a little bit of cost inflation around things like tubular goods. We've easily been able to offset that, I think, with efficiencies, and then you layer on top of that some pricing reductions in the industry, and my guess is their economics probably still don't look too bad. So is 60-something dollar oil a place that we need to be panicking? No, I don't think it is. And certainly we've talked about that publicly somewhat around what that means from a a return standpoint, even for us, what we're calling effectively bottom of the cycle right now, we might have called mid-cycle back a downturn ago or two. So the industry's gotten into a better spot, I think, as a whole, in terms of being able to weather a downturn's too strong a word, I think, but a soft patch.
Right. I think that's really good clarity, because, and I think it helps. I think it helps the industry to kind of step back a little bit and think about this, right? That's why I was in Austin with Bud Brigham and Matt Gallagher, and I was talking to industry folks, and I was like, look, this is not, it's not $45 oil. We don't have to lose our minds. And also, if you can kind of go steady Eddie through this, it's less painful, and we've proven it. That if you drop everything and you drop the rig count, you drop your frac crews and everything, the bringing it back is pretty costly. Yes. And so I feel like that's and I say this a lot because I think the service sector is just it's appreciated, but it's not quite as appreciated as I think people realize. Is that you need a really good, healthy service sector, just like I think you actually really need a good, healthy private E&Ps and smaller companies, because and you guys talk about this in earnings calls, you allude to it, is this diversification of players, right? Is that, I think it was about 3 quarters ago, Chris Wright was talking about, hey, we have done good as a business, right? The industry is, doing well, so maybe we need less frac fleets, or what number, pick the number. And we are at, just to timestamp this, so I was mentioning this to Ron before we started. Primary Vision has the frac spread count at 182 right now. And it's been kind of on this weird, wonky downward, but not like cratering downward, just kind of going up and down and doing this. But in these previous earnings calls, you guys had mentioned that, you have this high grading or upgrading, right? So it's when people are asking about how is production doing so good and how are things doing so great when we might not have expected that. And I think Chris was saying basically, you have these big operators and they've come in and they are drilling these multi-pad wells, and so we can get really efficient with our fracking, because we're simul-fracking or
Trimul fracking?
Trimul fracking, thank you. Trimul fracking. And that's just impressive, right? So you're drilling these longer laterals, you're efficiently fracking these, and so the efficiencies are hugely there. And so I feel like in 2022 and 2023, we saw lots of that, right? We saw a lot of that kind of efficiency. And so your industry, and you guys in particular, did such a bang-up job there. And I'm not sure that was completely appreciated of like the role of that. And I only say that because I would like to get into this a little bit of, we're at 13.5 million barrels per day right now of production, which is just phenomenal, right? It's just not something to like. It's partly why we're at $67 oil when we have all this geopolitical volatility. We are the largest oil producer in the world, and your business and it plays such a critical role in that. And so, but this high grading and doing all this great stuff and longer laterals, people always are throwing in this peak shale narrative now, right? It's all about peak shale, and we're going to come back to like these people dropping rigs and everything. But I just think it's really interesting, because I didn't have to go back many quarters in the earnings call to hear this commentary of how great we're doing and these efficiencies. And so I wonder if you can speak to that of like. And I know I always ask Lane Weirs about this because I love him getting nerdy on this stuff. But, like longer laterals, the efficiencies on the frac side. I know we might not have tons left in this space, but where are we sort of at? And if you could maybe even rewind a little bit and tell us, talk to that 2022, 2023, 2024, and then now, it's evolved, right?
It certainly has. And I think you could back up even further than that to have a really good look at the story. If you think about maybe headed into the 15-16 downturn and even coming out of that, like we were in a world where we were running 420 frac crews to support production at not close to the levels we were at today. You fast forward to today, and as you noted, Primary Vision has us running 182 frac crews. Rig count was at 1,800 when we really started the shale revolution, and now we do it with 550 rigs. It's we're victims of our own success in some regard, just in how much we've been able to move the needle with respect to how fast a well gets drilled and ultimately what that completion effort looks like. And there are a couple of pieces to that puzzle. First of all, you just have to look at the individual frac fleet itself, and that comes down to how much work gets done on location in a 24-hour window, just how much sand we can pump down hole in that period of time. And that number has continued to get better and better and better. And that's a function of how many hours a day we can keep an asset running. Lots of pieces of the puzzle there. Frac fleets have certainly gotten bigger. We've driven up the size of an individual fleet from probably what we would have called 40,000 horsepower when Liberty started to, now our average fleet's probably somewhere in the 70,000 horsepower
so
range.
nearly doubled.
So it's nearly doubled. We're pumping at much higher rates and often now into more than one well at a time. And so that certainly plays into that.
Right.
Simul-frac is a broad term. You know, in some cases it's a 30 or 40% increase in rate on location. And so modestly reduced rate into 2 individual wells. Maybe instead of 100 barrels a minute, it's now 70 barrels a minute per well in 2 wells. In some cases, it's a full-on doubling of the work we used to do. We've gone from 100 barrels a minute in 1 well to 200 barrels a minute into 2 wells. And so we've had to effectively double the size of the fleet on location to accomplish that. Assets have been improving. You know, we're getting to a more sophisticated asset on location. The ability to monitor that asset and drive up the longevity lifespan of a component on that has really improved, particularly with the data monitoring side of things. And we've talked a little about this on, I think it was even our last earnings call.
Yeah.
We talked about significant improvements in the lifespan of a power end or a transmission or time between overhauls on an engine. Those things have moved dramatically. We collect, I think the number is 1 billion data points a day now on our asset base running out in the field. And you have a group of people, but also a lot of hardware, a lot of computer horsepower watching that data to identify modest changes in trend that suggest something is about to go wrong. That becomes a minor maintenance issue instead of a major component failure. That means that maybe instead of that pump going back to the shop, a mechanic could address the issue in 20 or 30 minutes on location. And so when you used to pump, you know, maybe 14 or 15 hours a day, that number is probably north of 20 hours a day on average across the fleet. And you get cases where a fleet will run nonstop for days on end with no interruption in pumping. That's been enabled by a lot of the work that we have done on the frac fleet itself, but also work on behalf of our partners both on the supply side and on the E&P side. You have to have a supply chain that supports that. Right. So the water has to come at sufficient rate. The sand has to show up consistently to do that. The chemical has to be there. We had to see innovations around the hardware on location that allows us a seamless swap between wells with no interruption in pumping at all. And there's been a lot of work there. But all of those things combined have meant that today, to your point, we have 13.5 million barrels a day of production here. I think about 9.5 million of that comes from unconventional wells. And we're able to support that, sustain that with I think by Lane's latest numbers, maybe 135 or 140 oil-focused frac crews. That's phenomenal that we have accomplished that. Yeah. Just a testament to the industry, which is why I never bet against us.
Yeah, no, I don't either. And I think it's a really good testament. And I want to kind of, we'll pivot a little bit into this peak shale, but I want to take that moment of, because you guys mentioned this in your earnings call too about AI and just this, the sophistication of when you're pulling all these data points and what they're allowing you to see. I think you guys mentioned the Hive.
Yes.
In the earnings call, and being able to pull this in. So it's not just like it's real-time logistics that you guys are doing, but also it's this monitoring. And I think that's where, you know, I was coming up in the elevator and it was a little thing on Microsoft, I think, it was in the UK looking at diagnosing illnesses and how AI had done it like 4 times more effectively than doctors.
Wow.
Because it was pulling in all these data points. And, you know, I was just thinking, you know, we think about AI day to day of like, how can it help me research or how can it help me? And really it's probably these bigger things. And I think for logistics and everything and for little things of something vibrating too much or components wearing out or something, I assume that has to be something you guys are trying to integrate or looking at right now.
Yeah, the component piece has been a big thing. You mentioned the Hive. So 20 miles from here up at the tech center, we have a 24/7 staffed operation backed up by a lot of computer hardware that's monitoring all of that data and looking for signatures that may identify what we've seen in the past become a major component failure. With the goal being that we find that in advance and deal with it as a minor maintenance issue. And the numbers speak for themselves. I think we've seen about a 10% reduction in operating expense maintenance just this year in the last 6 months because of the evolution of the Hive. You know, that's phenomenal for us and our ability to help our customers execute at a lower WTI price and still be successful at that. And the same for our business and its sustainability at a more challenging pricing environment. And then you partner with that things like logistics. a piece of software now provides a 24-hour forward look at our expected inventory on location, given a potential truck plan. And we can evolve the truck plan, you can add weather, you can add traffic, and that will change the outlook for inventory there. That allows our logistics team to make adjustments on the fly around, maybe it's the number of pull points we're sourcing, maybe it's the number of trucks that are in play there. But of course our goal is to optimize that whole delivery system. We want a truck driver to get as many turns as possible in their shift. That allows them to maximize their return on their investment while driving down the cost of delivering a ton of sand to location, while making sure we never run out of sand on location. There are only a few things, shut down a frac crew, but not having sand would be one of them. So that's a big piece of our puzzle. I think we delivered maybe 1 million truckloads of sand in 2024 to support Liberty frac operations, just as a round number. You can appreciate that getting that right is pretty meaningful on the cost and success of executing in frac.
Yeah, I think it's and that's why there's so many angles to go through on this, but I think it's really important that it's a huge logistics operation. The massive logistics operation, you have to get it right. And all this really does matter because, it's not like operators are going to be like, hey, I'll just pay you a ton more when prices are high. Take a little off when prices are low. And it doesn't really work like that. I think they're kind of always like, hey, what's the best deal you can give me? And so the more efficient you can run, I really do think it's so important for folks to understand is the more efficient a company like Liberty is running, and we question, the analytical side of the community, I think, questions a lot, like how far left do we have on drilling speed times and frac efficiencies? And even we were at the Denver Earth Resources Library in the fall, and Lane was on a panel with me, and he just did such a great job of talking about these efficiencies. And it's interesting because if I ask him again, and I'll have to have him on the podcast, I would say he probably is going to say even from then, we've kind of incrementally moved the needle, not a ton, but little bits. And I feel like that incremental efficiencies, those are so huge, to your point of, when we're facing slightly lower oil prices, you can offset that a smidgen, right? It's because you're not going to say, hey, okay, well, and maybe I'm sure some folks in the service sector are, saying, hey, we need to increase our costs because we have, increased steel prices or whatever from tariffs. Mm-hmm. Well, that's not going to work. I don't think the operator's going to make sure, let's just do that. And, it depends on the operator, right? I hear lots of them say, hey, some people say specifically, hey, these tariff costs are increasing. I think Diamondback said specifically in their letter to shareholders, and which they knew everyone was going to read, and it was going to get out there. And in the earnings call that they were lowering the rig count and the frac count because they wanted higher 60s or 70s, really. And that they were doing this and just getting ahead of the market, but they mentioned tariffs and steel costs. Yeah. And I talked to other operators and say that is not a factor for them, right? It's 5%, it's 10%, but it's not how they're making their decisions. Right. And maybe Diamondback isn't necessarily making their decisions. They just put it in there as a component to say, hey, this is why we're not building out our ducts. But all of this to say is that these little things, collectively, materially matter when you're pumping, hundreds of thousands of pounds of sand, in a very short period of time.
They certainly do. Every one of those little things adds up and ultimately changes our ability to be economic in a different pricing environment. We are in a bit of a challenged environment today, but I think we've said as we've communicated with investors, if you look at where and I don't love the metric per fleet because of course fleets evolve with time, but if fundamentally you do look at the returns on a per fleet basis, they are very, very different in this down cycle than they have been in previous down cycles. And that's a testament to these little evolutions that all add up. To your point about what inning we're in there and is there more room to grow, I think the data says that only about 25% of wells are simul-frac today. Yep. Simul-frac is a massive efficiency mover. It has to be done properly, as with everything else. You can do it and really not feel the benefit of it, I think. But done well, it is an efficiency mover. And while not every pad in the U.S. could ultimately be a simul-frac pad, there are logistics constraints, space constraints, challenges that probably prevent that from being ubiquitous across our entire operation. I think the number's higher than 25%. Could we get to half? Maybe. Could we get to all the wells in the Permian being simul-frac? Very possibly. And so I do think there is room to run there yet. We're getting closer and closer and closer to 24 hours a day. We're still not there, right. But there are a few of these big step changes that could happen moving to trimul-frac or simul-frac or trimul-frac that are still maybe not that fully deployed. So we'll see.
Oh, that's an excellent point, because if we think about that, and I think various people, the way they look at this industry or approach it is very different, right? If you're on the drilling side, if you're on the completion side, if you're producing these wells, and so you can look at this from your own vantage point and say, oh, we're running out or we're low in inventory. It's harder for me to see that. It really, I've been looking at this my entire career. I cut my teeth on shale, and it's just hard for me because every time people are like, oh, we've got it all in the Bakken, and then it's like, you got it all? Like, because in the 70s, they said there was like 70 billion barrels, and everybody thought there was nothing, and then, oh, by the way, now we have the Bakken.
Yeah.
And so it's hard for me to think that the extraction process, we've got it all. But when you talk about this, like, evolution, it's really operators and acreage and acquisitions and blocking up this acreage, which we've seen tons of that in the Permian, where we had a lot of acquisitions. And there's like kind of the catch-22, right, where the rig count can drop a little bit because, and you guys have mentioned this in your earnings calls, when you have these acquisitions, you go from 12 to maybe 9 rigs or something like that. And so and it's, since COVID, we no longer have this straight line of completions, right? It's no, like, used to be kind of a mythology to ducks, but now it's kind of like some private operator might be, hey, we'll just duck for whatever reason, because they just don't feel comfortable with the market, or they do, and numbers of different reasons. So it's not always like we just run through these ducks or we just drill and we complete necessarily. So that spread with the publics and the privates, and the publics are, they're a little more streamlined. I don't think they're probably freaking out at 67. It's not amazing, but it's not the end of the world. But the privates, who have been this driving force during COVID and throughout it, have just been impressive because they respond quickly to price, and they also are the starter for this acquisition environment. And so it's amazing to me to think about that, we're nowhere near simul-fracking or trimul-fracking the entire Permian, because we still have so many of these little privates everywhere, and actually across the country. Think about Oklahoma and Haynesville and Wyoming. I mean, just like, we are just not fully, blocked up for all this stuff. So, and you just don't have the speed and the growing room. So, I just think of these, when we think about, okay, simul-fracking and trimul-fracking and the big guys, then you think of these smaller guys, and this is where the fringe acreage, and you guys don't say this in your earnings call, but there's a lot that can be gleaned from listening to these and understanding the market, is that it was either you or Chris that said, in the future, yes, the acreage will, not degrade, but it's not going to be the same acreage, right? We're drilling up the good stuff, but that just means more horsepower and more sand. And so, when I was in Oxford a couple of years ago, I was explaining this, at their oil day, and at Oxford University, and I was explaining to these guys, like, this is what the industry has done. In 2022 was all about gas prices, but 2023 was about the service sector, and really kind of almost high grading this acreage of, when you are pumping more, you got more horsepower and you're pumping more sand and more fluid, you're taking that rock to where kind of whatever so-called tier 1. Do I have this right? Am I thinking about this right? And can you talk to that a little bit?
Yeah, I think it really comes down to just how many square feet of rock you ultimately need to touch, and that's really been the evolution. If you back all the way up to when Liberty started, the completion in the Bakken looked very, very different than it does today.
Absolutely.
We've evolved the completion to best suit the reservoir, and even now that we've gotten all the way to this iteration of a slick water frac job with 2,000, 2,500 pounds of lateral foot and a water volume that suits that, even that recipe has to continue to evolve given the changes in the reservoir and the changes in the macro environment. What is the right completion at $85 WTI is not necessarily the right completion at $65 WTI. If you're going to maximize the return on investment from a well, you might tweak that completion a little bit. But that's an important part of the engineering process. It's why you don't always want to get into factory mode, so to speak. That there is value in having a look at that completion design, maybe quarterly or semi-annually or whatever the case might be. It's still a very important part of the puzzle here at Liberty. I think many of our peers have chosen to exit that engineering world, to choose not to be alongside the E&Ps in evaluating the success of a completion, the performance of a reservoir, and the optimal completion design that should go into that. We have stayed true to that for that very reason, that we think that's a critical piece of the puzzle. And to your point, I think it will need to continue to evolve as we look at ever-changing and arguably degrading reservoir quality. And we'll have to put a different completion in there to accomplish that. So I don't think it's the end of the world by any stretch of the imagination. You know, we've been, I think, very successful in holding returns at pretty strong levels despite changes in reservoir quality to this point in time. And I don't think that's going to change going into the future. I think we'll continue to find ways to produce economic volumes of oil or gas out of reservoirs, even as they get a little bit tighter or the reservoir quality gets a little lower going forward.
This is a good, I think that's fantastic, because this is where I think kind of tiers are in the eye of the beholder. And this is where I do push back on the peak shale narrative, because I just think, you know, what it's like saying, you know, tier 1, tier 2. And I always tell people, well, did we all get together and did we all decide what is tier 1 and tier 2? Because, you know, I think operators kind of disagree. When somebody buys somebody else's acreage that they didn't like, and then they go turn it up and they prove it up and then they go sell it back to the big boys, I feel like they've kind of taken that tier 2, put it back into tier 1, and you guys have a huge component of this. So I mean, it puts a question mark on this. I even kind of lesser reservoir. It's different, right? It is a lesser reservoir. The quality is not the same, and so we'll take a different frac. But that's where I think and I think folks abroad and the industry has to appreciate that. By no means is the industry done, even as rock quality is not quite the highest quality, is that this industry, the service sector, so important to understand is what you're doing. And I feel like that's just huge. I feel like we've missed in the past year or two, you know, 3 years. And you know me, I talk a lot about market intelligence. I feel like the industry has failed. You know, really, we're not doing as much of it as we used to. You guys do it in your earnings calls, but you know, the big guys used to do it, and they don't really talk about the industry as much. But it also gets to thinking about the market, where you guys see yourself, and you guys are doing. I mean, you're doing a lot. So you're not just doing. I mean, we can come back a little bit to you know peak shale and production, and maybe we can close on that. But I would like to talk about your kind of step outs and some things. You're in your earnings call. You talk about Australia. That's one. So and then LPI and power. And you know, I had Roy Ani on the podcast for a long one a couple years ago, and we had like a 2-part, and we really got nerdy and deep into the weeds on everything. But that was kind of LPI and power, and I wouldn't say I was ahead, but I did know where you guys were going with this, right? And you didn't say explicitly within your earnings call, but everyone, if you're watching power and you know this, we kind of know your skate to where the puck is going. So I think LPI and power, and then talking about digi and electric, and just, you know, because those kind of the blend a little bit, evolution of the frac side. But maybe let's start with, and of course, anything you don't want to talk about or you want to skip ahead or interrupt, that's fine. But what about Australia? I mean, you always open these earnings calls with talking about Australia, and you were just there. You put these pictures on LinkedIn. So tell us about Australia and what Liberty Energy is doing in Australia. Yeah,
excited about Australia. Of course, we've always been big proponents around growing the available supply of energy for the world, and recognizing that natural gas is going to play a big role in that over the long term. Continue to be excited about places where that could come from, particularly geographically advantaged to supply in Asia, where I think the largest share of demand growth is going to come from in the near term. And you know, I'm a transplant from Canada. I've been frustrated with our slow approach to being a part of that puzzle, but I think the first cargo just left the West Coast today or yesterday maybe. So excited to see Canada stepping in there, but Australia was an opportunity, a location that we viewed as incredibly advantaged in terms of being able to provide that supply. And here you have the Beetaloo Basin, maybe 5 million acres, give or take a little bit, that I think has 10 or 15 wells in it today. It's basically an undeveloped onshore resource.
Where's the Beetaloo Basin?
So it's in the Northern Territory. If you flew up to Darwin, which is way up there at the top of Australia, and then drove maybe 5 hours south, you would south and east, you would find yourself in the Beetaloo Basin. And so it's early days there. There's a massive gas resource there. The numbers, the numbers put it at, I can't even remember how many TCF of gas there are, hundreds of TCF of gas in place.
A lot of gas.
So it's a lot of gas.
And probably more than there.
You have some things coming together there now that I think have helped to support that. First of all, an acknowledgement that natural gas is going to play a meaningful role in global energy supply for decades to come. You have layered on top of that a situation in Australia where they are actually getting short onshore gas supply for themselves. Yep. They are rapidly finding themselves down along the south part of the country in a situation where not too many years from now, they could have a hard time with the needed gas supply just to keep the heat going and industry running and things like that. And so there's been a recognition there that they have to do some more work developing onshore resource to support even themselves. So you have some factors coming together that I think have maybe pushed the Beetaloo Basin up as an area of interest. We were approached by one of the smaller operators there, so there's a couple of operators that hold a pretty meaningful chunk of that acreage between the two of them, around bringing North American expertise to help unlock that basin. They have, of course, there are drilling rigs over there and there are frac crews over there, but they have been typically geared towards more conventional development. Right. And so they don't necessarily have the expertise or even the kind of next generation capabilities that would allow an optimal well to be drilled and completed in that basin. And so H&P made a commitment to take a rig over earlier, and then ultimately we made a commitment to send a frac crew over there. That was delivered last year, and we fracked our first well there in January of this year.
That's awesome.
Excited about what that ultimately could lead to, but there's a lot of work to be done there yet. The sand that went into those wells came from North America. We bagged up, 40 or 50 million pounds of sand and shipped that by boat to Australia. You can imagine what that does to the cost of a well when you have to ship sand from North America. Things like that are evolving. There is going to be a local resource developed there that will allow sand to come from, I think, right in the basin. But all of those little incremental steps take some confidence that there's going to be development in the basin. And I think seeing H&P commit a rig, seeing Liberty commit a frac crew, seeing two E&Ps out with some economic or some equity raises to help support that development, and now I think maybe even some larger E&Ps starting to look at that basin from the outside have really provided some confidence. That has been backed up by the fact that particularly in the Northern Territory, the government is all in on seeing this development go ahead. I had the opportunity when I was there to meet with the Chief Minister of the Northern Territory, and she and that team are, I've maybe not seen somebody so engaged in the potential success of a basin as she was and her team is. They have gone so far as to create a department that is there solely for the purpose of helping to accelerate development of both mining and oil and gas extraction. And of course, that's really what the Northern Territory economy relies on, is those two things. It's exciting to see those initiatives in place there. That gives, I think, me as a business there confidence that we're betting on something exciting. They already have some LNG export out of Darwin. There are already a couple of terminals up there. And so you have onshore gas demand, you have LNG export, geographically advantaged, you have a massive resource that's very, very early days. And so, I think it'll be maybe a few years yet till we see a number of rigs and a continuous drilling program. I'm excited about the prospects there, and we're excited to be a part of it.
Yeah, no, that's really fantastic. And as a geopolitical nerd and someone who pays a lot of attention to Asia and spends a lot of time on China and just like the geopolitical map and does work for the government, I think Australia is pretty important. And so it's a natural, it's very interesting because they are a country not completely dissimilar to Canada that, has very much embraced climate change and the policies, but also is dealing with the recognition of, oh my gosh, we have these resources. And, Australia is the largest exporter of coal to China. And so it's always amazing of they must have a lot of cognitive dissonance. I think it's sometimes within different provinces and governments. But the Northern Province, and I would love to get up there and talk to these people, because I think that message probably needs to get out more, is that this area is open for business, right? And they want to attract this. And I always think when people ask this of, okay, well, what's there? Well, you don't know until you start doing it, right? You have to start fracking to actually see. And I spent a week in Bahrain when they were dabbling with their unconventionals in 2018, right? And you have to just do it, right? You can't just kind of like, I want to say half-ass something, but you can't, right? You got to kind of tinker. And I think people forget that we do thousands of wells a year. I was looking at doing some forecasting to actually look at what we could do to grow production or decline production in the U.S. Okay. And so when you look at completions, and we're talking all completions, right? This is
verticals and everything, and they get smoothed out. But we're talking like 1,000 completions total of everything a month, right? So when you think of that's a massive amount of data, there's a ton of learning. We're doing that every month.
Yes.
And so you're talking about industrial, it's like a couple,
Yeah.
Right?
It's a very small number. Truly, our learning opportunity here, our training ground is unrivaled any place in the world. And so it's logical that companies look to North America to get that expertise. And
it's also logical that they look to you guys too, say hey, come help us. And
certainly, we were excited to be asked, and of course the engineering team here working hard alongside both the Tamboran and Beetaloo Energy teams to help evolve those completions. It is an interesting reservoir, and it's of course different than any reservoir we work in here. And so while at a high level the concepts of big high rate slick water fracs work, it has to be tweaked every place we go to work. To your point about the country as a whole, like other places, I think the pendulum is swinging back the other direction. It's amazing what happens when the impacts start to directly be felt by the population there. And of course, energy prices have been climbing. The grid is like other places getting a little bit more challenged. And so I think there is starting to be a broader recognition that the energy picture is more complicated than it has been made out to be. I gave the Bettering Human Lives talk a number of times there. The acceptance of that talk and the perception around that being the message that needs to be heard was phenomenal. We already have a number of invitations to come back and give that in other cities we weren't able to visit. But I do feel that, like other places, pendulum is swinging the right direction, and there will be a more pragmatic conversation around energy take place in Australia, both at the state level and also at the federal level.
Yeah, and I mean it's so important because I've actually done I war gamed, and I did a week, and it was interesting because it was actually a blockade on Australia that we war gamed, and it was very interesting. Just from you don't know who red team is or blue team is, but you know who red team is, blue team is. And it was just very interesting from an energy perspective, which is my expertise that I brought to the table. You just can't, you do something like this and you realize you have to produce and you have to have stockpiles and you have to have storage. But Australia is 14, they export roughly what we do, right? 14 BCF a day. And so, we export about 14 billion cubic feet per day of gas. Australia exports about 14 billion cubic feet per day of gas. Qatar exports about 14 billion cubic feet per day of gas. So you have these exports, and that's, there's a little bit more, but it's, I think in 2023, it was like 53 BCF a day were LNG on the water.
Okay.
And it's always interesting because for us, we think about we want to export more because our gross withdrawals are like 130 billion cubic feet per day. Whereas these guys, the 14 BCF a day is largely their production. And so when you talk about this, I can only imagine the excitement of these people of we if we unlock this, one, we have abundant domestic supply, but we can also export this. But they have to build the infrastructure. And that's not dissimilar to what we always see in India, a lot of hope for natural gas. And this is not undoable, right? It's doable, but you have to build pipelines and infrastructure. And Australia, it's a big country. There's a lot of rural and rugged terrain, and so you'd have to do this. And I think you have to get, took us probably a decade to get the Japanese to believe that we had as much natural gas as we say that we have. We're like 100 years, don't worry about it. And they're like, really? So I can only imagine when you're starting this up in Australia, they have to believe what they've got, and it takes companies like Liberty to say, help you frack this and see what you've got, and can you replicate this in multiple wells? Yeah.
So we will see. It's still early days, but cautiously optimistic.
Awesome.
I'll say.
So are you? Is it a dedicated crew? Are you allowed to answer that?
So the crew's over there to work for whoever. I would tell you today the work is still pretty intermittent. Tamboran's a public company, trades on the New York Stock Exchange. You can follow how much work they're doing, and we completed a well earlier this year, and we'll go back and do a little bit more work a bit later this year, and then some work again early into next year. Beetaloo Energy's fracking a well right now, and so it's pretty intermittent at this point in time, and it will be next year as well as I think they begin to figure out the reservoir. Work towards commercial production, ultimately get to a scale that the development can be continuous, or somebody with much deeper pockets arrives to turn it into a steady drilling program. But it's a stepwise effort, and it's going to take a few years yet. So today intermittent, and that's okay. It will, we believe, get to a place where it'll be a consistent frac crew, and I hope we have to send a couple more.
Yeah, that's awesome. No, that's really great color and context. And it just reminds me, actually, coming back to this of, we're talking about $67 oil, and actually, how the industry is actually more profitable and healthy than they've been, in a long time. Actually, we burned through tons of money early in the shale revolution, hundreds of billions of dollars. But it took, I'm not saying that was good, but it took the burning through and let's go drill a well, and we failed, okay. But we learned a lot.
We did.
And you have to have that ability, and this is where if you go abroad and you talk to people, and I did this early days, I was in Saudi Arabia or Bahrain or, in Oxford, and telling people, and I always say the nimbleness of our service sector, you have to appreciate, you just have to have, I love liberty, but you have to have, that you can't just be liberty, right? Liberty is not everywhere. No. And so you have to have multiple service companies, and you have to have the tiny operators and the big operators, and this multiple entities doing business, and the well sucked, and then you move on. We don't even have we don't have dry holes anymore. You don't hear about companies being oh, I got that dry hole, and that's kind of amazing. I'm thinking young people fracking are they probably even don't know what a dry hole is, And so when you think about Australia and places they have to experience this, they have to go through this of well, that sucked, and it's hard because they have to realize you're going to have to dump some money into this. And I wouldn't say subsidize, but in many ways, we lost, it wasn't giving back a lot of money, but now it is. And I think that's what's so fascinating in this narrative of peak shale is you're saying this, people are saying this when the industry is as profitable as they've ever been. They actually recover from COVID better. They far less rigs. 554 rigs to probably hold production flat, which is amazing at 13.5 million barrels per day.
Yep.
And 182 frac crews, and we're still making money. And this is peak. I call BS on it. I just think it's...
We're a market-driven business. The businesses that are in this space respond to price signals that give them clarity around what their forward look could be. There's also investor sentiment around that, and what the reinvestment rate could be. But I'm certainly of the opinion that we are going to be in a more challenged supply-demand environment by the latter part of this decade for oil. We know where the barrels are coming from for the next number of years, the next couple. We've had some long cycle barrels come on, and they'll continue to come on over the next little while, and that's going to meet the 1 million barrels a day of growth we'll see year after year. But once that's done, there hasn't been a lot of exploration going on for the last little while, and so where that incremental 1 million barrels a day is going to come from in 2029 or 2030 or 31, I think is a little grayer today. And if that is the case, if that hypothesis is right, that we are going to find ourselves maybe upside down from a supply-demand standpoint, there will be a price signal that comes with that. That may be $100 or $110 or $120 WTI. And certainly, if there's that sort of price signal, do you expect the North American market to respond to that opportunity? Absolutely.
Right.
Of course we will.
Right.
And if it makes sense to grow production at that point in time, even if the publics aren't prepared to your earlier point, we're going to see privates step up with a meaningful opportunity for tons of cash flow
and, all of a sudden
respond.
All of a sudden that crappy reservoir doesn't seem so crappy.
Not so crappy at $110.
Exactly. Well, that's a great, okay, that's, so I want to pivot into LPI power and digi stuff,
right.
But gas is a good starting point on this because we're at $3.48 right now for natural gas. Not amazing prices. And, we can prognosticate. I am a slightly different, I think we have to be careful when 1 million barrels a day just isn't that much, right?
Mm-hmm.
It's a lot and it can move the market, but, if prices go up, as you just mentioned, the market responds. And so for gas, we are just so dang good at the industry is so good at fracking this gas that, it's a smaller molecule, we just get tons out of the ground. And so we have so much. And I was just looking at, the latest numbers, 130 billion cubic feet per day, 130 BCF a day of gross withdrawals in the U.S. That's an all-time record high for gross withdrawals. As in March, that's astounding, and it just keeps edging up. So really to help with natural gas prices, we need more to get into the power sector. We do need to export more, and we need to have these these centers they can grow, and so we can have stabilization. But this is where you guys talk a lot about power and LPI in your earnings call and what you kind of see for this. So I'll let you kind of just take that. We can get more specific, but take that and run with it.
So I am quite excited about the gas market. I do like that opportunity, and I would say we are overweight gas exposure today relative to the rig count that's working there. And
what do you mean by that?
We have a higher percentage of our frac fleet working in gas than you might expect given the percentage of the rig count that's working there today. So we're overweight gas exposure and underweight oil. And there's some reasons for that. I think some of them you've alluded to. So power generation, that's an interesting piece of the world, and the forecasts vary a fair bit, but it looks like we're going to see an incremental 5 to 8 BCF a day of demand growth just to meet power demand onshore, lower 48. You could argue it's 5, you could argue it's 8, maybe we even exceed that, but that demand feels pretty real to me, and I think is going to be an important part of the conversation for a few years to come. And then you layer on top of that the LNG export capacity that we already have line of sight to. And so you can see and make a pretty strong case for an incremental 15 to 20 BCF a day of demand between those two situations, never mind reshoring of manufacturing or whatever the case might be, that could provide additional tailwinds there. To your point, we can absolutely do that. I don't see any huge hurdle between us and accomplishing an incremental 20 BCF a day. Really, the question is just where it's going to come from and how that'll be divvied up. Are we able to get some infrastructure built up in the Northeast that allows that to be a more meaningful contributor to that? Or do we rely more on the Haynesville, and we'll see what happens in the Permian with time and what gas production ends up looking like there. But and then there'll be a few other places that factor into that. But like the outlook for that for years to come, do see some potential volatility in the LNG market in the coming years, just given the massive build out there. And that could just be modest mismatch in supply and demand, but it'll be short-lived, I think. Exactly. Demand will very quickly catch up, and so those will be blips in the market. That said, we also saw that as an opportunity, particularly this power side of things, to take a step forward in growing our business. The oilfield services business is a business we remain quite excited in and invested in, and we'll talk maybe a bit about new technology and where we're going there, or next generation fleets. But there's a natural cap to that. We're roughly 20% of the North American market today, plus or minus. I could see that continuing to grow modestly as consolidation occurs in the space. More and more large E&Ps that have expectations around the type of fleet, type of company that comes to work for them, high grading their capacity. And so we get a larger share of arguably what's going to be a little bit smaller pie. And so as you start to think about the long term, we've always said we're building a generational company. We are in this for the long haul. This is a company that I would love for everybody here to be able to have their children work at one day. And so what does that mean for Liberty Energy looking forward? We intentionally changed our name a few years back. We started as Liberty Oilfield Services and recognized that was not going to be broad enough to capture all we wanted to be. And so we rebranded ourselves as Liberty Energy and started to think about what that portfolio would entail. We made some early investments just as partners to have line of sight to technology development to support some things that we viewed as important to the market. And things that we ultimately thought maybe could be a part of our world going forward. So we made an equity investment in Fervo, enhanced geothermal. We made an equity investment in Oklo around the development of small modular reactors, and then an equity investment in a small battery company that uses a different technology, Natron, that uses sodium-ion technology instead of lithium-ion. Okay. So an entirely onshore supply chain.
Those are the solid ones, right?
They are. So it's not a solid state battery per se, but it's no thermal risk at all. Right. So you put them out on a frac location, don't have to worry about that. Very high charge and discharge rates, even compared to lithium ion. So they have a very high C rating, and total cycle count on a battery can be meaningfully higher than a lithium ion battery. The downside is they're not quite as energy dense. So they probably don't make sense maybe so much in the automotive world, but in a place where footprint is less critical and you can tolerate a bit lower energy density, they make a ton of sense.
Yeah, an offset. So you're saying you've listed batteries, batteries, nuclear, small modular nuclear reactors, and I had heard that in an earnings call too, and I was surprised no one asked a little deeper questions. But that's it. Those are incredible because that means you do have, I think about that too. When I have a diverse portfolio of clients, I have a diverse portfolio of how I see the world, right, and how they ask questions. And so if you have a diverse portfolio, even if you're not actively doing a whole lot, but if you have these investments, it does give you a line of sight into what's going on and how to think about it, and then also how to integrate that.
Right. We give the Bettering Human Lives talk a lot, and a lot of that conversation is how the energy stack is going to evolve. We are not of the opinion we're in a transition, which would imply these things are going away and these things are taking their place. Instead, addition, probably a better case. And it's certainly our hope that each of those will play a role in that energy stack going forward. And so for us, as we thought about what that meant, having an understanding around those technologies, particularly as they pertain to our world going forward, was critical to us. We view nuclear as a very, very important technology to continue to advance as part of an evolving energy mix. It is probably the one technology that offers both the opportunity to generate electricity but also supply process heat at very high temperatures for things like cement or steel or
big
petrochemicals, big industrial applications. No other proposed next generation solution really offers that opportunity to supplant hydrocarbons in that role. So we like nuclear for that. That ultimately evolved, of course, to us starting to think about how we could play a role in the power business. So we got into power generation as a result of moving our frac fleet to next generation. As you thought about fueling a frac fleet with natural gas, initially the way that was going to happen was to take natural gas, generate electricity, and use an electric motor to drive a pump.
And so the electric frac fleet.
Yeah.
Yep.
And so today we operate 130 megawatts of power generation to support our electric fleets out in the field. We've ultimately evolved to a slightly different path there, a more direct drive solution, but regardless, that had us build a meaningful amount of expertise in modular, highly mobile power generation using highly efficient spark ignition gas recip engines. And it became very, very clear to us as this power conversation got bigger and bigger and bigger that we could take that expertise we had built, arguably expertise that was unique to us in the oilfield services space, and take that outside of oil and gas and use that to help address the challenge that we've seen. We've had a situation over maybe the last decade or more where poor policy decisions have had us build intermittent power generation primarily, rather than good baseload power that's capable of being dispatched whenever you need it. And now we have an end-use application that doesn't fit well with intermittent power generation. You can't run AI only when the sun's shining or the wind's blowing. They want 99.999% uptime. And we have a grid in a number of places now that is unable to meet that incremental demand in the time frame that they are looking for it. They might be able to get there in 3 or 4 or 5 years, but today, if we stand up a data center, in many cases, the grid says we're not able to support that. And so we've had tech now out looking for alternative solutions to this. They have now become our best friends. And we recognize this is a massive opportunity. If you thought about the scale of our business today relative to the scale of power demand growth, I don't know what the exact number is, but it's north of 100 gigawatts. It might be north of 200 gigawatts of incremental power demand. If Liberty were to deploy 3 or 4 gigawatts of power generation, that doubles the earnings potential of our business. So we need a very small slice of what I think is going to be a really, really big pie to meaningfully change the scale of Liberty as a company. And
that's through LPI. So it's Liberty Power Innovations, right? Is
yes.
When you started with this?
That's
and that's
right.
through LPI, right?
That's right.
Which kind of encompasses not just providing the gas and for the electric frac fleets, which we can talk about shortly, but also providing power to folks in the field. And this is where you talked a little about that earnings call. Would be nice to break down. Like you providing power in field. I hear you go to Midland, you hear this too. Is like everybody's complaining we don't have power, and I'm like, oh,
right.
This is awesome for Liberty. Not awesome. The problem isn't awesome, but it's we have ways to solve this because we have a crap ton of gas.
Yes.
So providing power in the field, but also providing power to these data centers. And want to comment and mention just that you're coming on the building to the power demand growth, I think it really is underestimated and underappreciated in the role of nat gas. So so how does it work exactly with LPI and those different divisions?
So to your point, there are a number of opportunities where we need power. Data centers are the one that are talked about in the news all the time, but they are not the only ones challenged by this grid issue. Our customers are working hard to electrify their acreage. They're working to electrify production facilities, compression, artificial lift. But there's not power out there necessarily to do that. The Permian is extremely short power. We've had customers standing up and talking about it for years now. But it is a readily fixable problem. We have the gas available to do that. We have the generators to be able to go out and supply that power. We can build a microgrid on somebody's acreage position and electrify all of that without having to rely on ERCOT in any way, shape, or form. Maybe ERCOT gets there at some point in time and can backfill that, but in the very near term, on a relatively rapid time frame, we can accomplish that outcome. And so that's an important piece of the puzzle, is just our own industry and helping to electrify that. So that's one piece of the world that we're talking about. Data centers, another piece. But there are lots of other commercial and industrial opportunities out there. We've talked about reshoring some amount of mining. I don't know when the last time a mine started up in North America, but it's been a long time. But we're talking about that again today. Those tend to be very remote operations, and they need a lot of power. That underground operation is an electric one. And so we have the ability to be a partner alongside of them, even if they're not adjacent to a gas pipeline. LPI is in business because as we transitioned our fleet to burning 100% natural gas, we worried about that as a fuel supply. Diesel's ubiquitous in our industry. You can find it every place. So you rarely worry about running out of diesel on a frac fleet. But we worried about running out of natural gas.
And the right type of gas.
Yes, it is a complex molecule to supply. I don't think people often appreciate just how complicated it is to compress, deliver, decompress, and deliver the right quality of gas to an engine to assure the right outcome. And so we chose to take that in-house to make sure we had control over that. Efficiency of our frac fleet and our ability to ensure for our customers the kind of uptime that they are looking for is critical. And so that's one of the pieces of the puzzle, just like power generation, that we viewed as so important. What that means, though, is that as we start to think about these other applications for power generation, to the extent they need access to gas and it's not coming from a pipeline over there, we can make sure we have that. We have a mobile molecule of gas that we could support there. We also have in-house a midstream team. So to the extent we need to go to a third-party company, procure a gas contract, and then design and build a pipeline to transport that gas, we have all of that capability in-house at Liberty. And so it enables us to go to any one of these end users with a comprehensive solution around delivering kilowatt hours to them. They don't need to worry about the fuel supply. They don't need to worry about the pipeline. They don't need to worry about any of those things. We can own everything from that tie into the pipeline to the rest of the balance of plant, and ultimately just deliver them a power purchase agreement that provides them some confidence around access to and even the price of electricity for years and years to come. And so we're quite excited about that. And while the solution will look different depending on the end user, the pieces of the puzzle that we ultimately have to bring to bear will vary case by case. Our goal was to ensure we had a comprehensive solution that would appeal across the board, regardless of what your needs were and what pieces of the puzzle we had to help with.
That's I love this because you're just speaking extremely nerdy language of, I think it just comes back to like you were talking about the, I don't think we appreciate the logistics and the complexities of all the things involved in the frac operations. And the same goes for natural gas. It's an extremely amazing, nerdy world, but it's not the same. And you mentioned like it's not all the quality gas is not the same. Mm-hmm. Field gas is different than a pipe gas. And then you mentioned power purchase agreements, which is fantastic, and mining. So I want to touch on those, but can you just for listener and people that don't understand this well, the field gas, like can you use field gas in these, so if you don't have the pipeline gas, you can get it field gas. What do you need to do to it? What do you got to do to clean it up? And is this super complex or is this pretty doable? And I spoke with Roy about this, probably it was this a couple years ago. Yeah. And I'm wondering if it wasn't undoable, but I'm just wondering is that it's gotten a little better since then, right?
So certainly it's not undoable, but if you thought about, we have a couple of technologies you could bring to the table to generate power. One would be a gas turbine, aircraft engine effectively, connected to a generator. The other, a gas recip engine, more like what's in your car. We have specifically chosen a gas recip engine for a handful of reasons. I'm guessing Roy got pretty nerdy about that stuff. But fundamentally, at the end of the day, it's about the efficiency of converting a molecule of energy over here into a useful electron over here, and the efficiency with which that happens. A gas recip engine will extract about 45% of the useful energy out of a unit of gas and turn that into electricity. That's on par with the grid today. If you took the average of the North American grid, it's about 45% efficient in its conversion to electricity. So we're head to head with the grid today. You cannot get electricity any more efficiently off the grid than you can from one of our standalone engines. If you choose to use a turbine, it comes with some benefits, but also some cost or implications. It is much less efficient at accomplishing that. Depends on the turbine you choose,
right.
but probably you'll burn about 50% more fuel to accomplish the same power output at the end of the day. So if you're thinking about emissions and the volume of those, and you're thinking about the cost of your energy, to the extent you can, a gas recip engine makes a ton of sense. But that efficiency also comes with some trade-offs. It requires a relatively consistent and relatively pure gas stream. Mostly methane, a little bit of ethane, so the two simplest molecules. Anything beyond that and life gets a little more finicky. The engine starts to derate, starts to produce less power for the same unit of fuel. And so the ideal case, and in fact, quite honestly, the vast majority of the gas that we consume today comes by truck. It comes from a compression facility behind a gas plant. Yep. 99% of the gas we burn, I'm guessing today, still comes that way. Our access to field gas actually relatively limited by virtue of the fact that we typically work on new pads that don't have infrastructure in place to deliver gas to that location. That happens after the fact. Yep. It's not true every place. There are places where field gas is absolutely available. If we were wanting to consume that in the asset that we bring to location, we have to clean that gas up. We have to remove all of those heavier molecules. That's not impossible by any stretch of the imagination.
You need like a mini mobile.
You need a mini mobile gas plant.
Yep.
And we have that capability for sure. That from an engineering standpoint, it's very doable. It's maybe not the ideal way or mechanism by which to supply gas to a frac fleet, but can it be done? Right. Yes. Are we doing it regularly in the field? Typically not. And I think that's mostly because there's just not field gas right there.
Right.
But we can do it. It's a riskier fuel supply for sure.
No, but that's great because this is why I was out in Midland in May, it was April, and Fasken took me out on a field tour. And they're a private company, so it's great because the tour is yours, Yeah. And so I saw their gas plant, and it's their gas plant, right? Mm-hmm. They had to build their own gas plant because they had, and it's only their gas that goes in there. And it's just kind of amazing because you think, gas is such a big issue in the Permian Basin. Yeah. But then you could go to that gas plant and then just take that compressed natural gas, that CNG, and then use it for whatever you need to use it for.
Right. And I should maybe preface that with the idea that not all gas comes out of the ground equal, right? In the Permian, it comes out as associated gas, so it's got a fair number of heavy molecules in it. But if you go to a dry gas environment, very likely the gas comes out of the ground in a form that probably is quite usable by us with very, very little intervention. In Haynesville, for example, we burn field gas there. You may need to scrub out some CO2 or H2S or some associates like that, but otherwise the gas is burnable in the form it's produced out of the ground. So it definitely varies basin by basin what that looks like and how you would answer that question.
And for the geology nerds listening, this is just where it gets cool on the rock. Like the Eagle Ford, everybody's getting back and excited about the Eagle Ford, and I just remember the API gravity gets hotter. It's higher as you move into the play, and you go from the oil and the non-oil into oil into condensate and varying API gravities into the gas and the dry gas, and so you have all of that in there, and it's the geology and the depth and everything that makes that. So that's really cool. And I can only imagine that the technology if the demand was there and the price was right, you could provide that.
Absolutely doable.
Yeah.
Yes.
So, so you're bullish on this, and this is why I understand you're bullish on gas. And I love that you are, because you mentioned this, I think, in your earnings call too, where you are a little disproportionately, or not disproportionate, but you're tilted on the gas side. I think that's important for the market to understand is that folks are fracking gas, and so obviously that's why we have such high production. But we also, when I looked at the gas rig count, we actually notched up a smidge. And we've sort of held at, 100 rigs kind of flat. We're at 111, and it's not massive. It's kind of still really flat. But it's just impressive because, we produce over 20 BCF a day of associated gas in the Permian. We produce tons of associated gas, but we don't appreciate, like, Haynesville is, these are phenomenal wells. When you're talking, like, opening up a well and they're 10,000 MCF a day, like, this is just incredible, right?
Yeah.
Like, so it's easy to produce, but and I think this is where you get so much excitement, I always talk to the Dallas bros, of like, you get so much excitement from folks that are in the gas place and thinking about the future because, they can see a pathway. Like, investors can see a pathway. And to your point of, needing to, mine something, right?
Mm-hmm.
And everything, actually, I think that this administration and Chris Wright has been talking about is, reshoring, manufacturing, doing things in America. And I think, it's critical to this because it was last night, I believe it came out, that the U.S. is going to stem some of the weapon or some of the ammunition sales that we had committed to Ukraine. And the reason we are doing that is because we are low on ammunition. And I've been talking to folks about this for years that, you can't, it's not, you have to make it, right? You have to replant this. So if we're going to continue, in Germany and all these countries are going to do this, you need power generation to make this stuff, right? You actually have an industrial thing to build these bullets or ammunition or whatever it is. And it takes power. It takes either natural gas or coal-fired power or, to your point, nuclear, but you have to have it. And so I feel like it's the one thing I haven't heard with all this talk about NATO and increased spending, and I keep reminding folks is, you have to have an industrial base. You have to have power, and it's not going to be wind and solar, which is intermittent and unreliable and not dispatchable, that's going to actually help you build this ammunition. And so we're actually at a critical point where, we have to build this stuff. And so I feel like everybody's talking about AI, and that's very real because, just the computational needs are huge, but it's actually just the real, like, bread and butter, like, real Rust Belt stuff that we need for power.
Yeah, I'm obviously lots of just straightforward industrial uses for energy, and we need to be able to support those. I don't doubt in our ability to get there. You raised the point of Europe, obviously in a very, very different situation. You have a country like Germany that used to be an industrial powerhouse, the same with the UK, who really was the birthplace of the Industrial Revolution, who have been effectively deindustrializing by virtue of energy policy decisions that have made energy so expensive and in some cases unreliable that industry has had to pack up and go elsewhere. They have chosen places where they have access to low cost, reliable energy, and they can make stuff cheaper.
Yep.
And so now, as you start to think about reinvesting in the military, as an example, this goal of getting to 5% of GDP as a target, that has some real implications behind it, particularly in countries whose energy situation has been drifting in the wrong direction. So I think, again, now you've got Germany, who shut down all of their nuclear last year, now wondering if that was the right decision, and ultimately having to revisit that question. And I don't think that's going to be I don't think that's going to be indifferent to a number of other places that will face that same challenge. So it's again, back to just the high level point, brings back a more pragmatic conversation around energy, its role in our world, particularly from a security standpoint, and the importance of it. Energy underpins everything that we do, and people forget that and unfortunately take it for granted too often.
No, it's great. I literally say energy is everything, like, period. Like, it's just everything. You guys do such a good job of talking about that and the bettering human lives. Okay, so the last two things, because I know you need to run and I've taken a lot of your time, and you're just a wealth of intel, which is amazing. Okay, so let's talk about, like, LPI power. That's amazing. We know we need this power, and the world needs more energy. There's something I was just thinking about when you say, we can provide these solutions. So there's just two parts with this, utilities, and then I want to get into closing on, Digi and your electric frac fleets and sort of the state of the frac fleet and where we're sort of going. Is there an offset, like, and you don't have to be critical, but I am. I'm very critical of Xcel Energy for what's happening in Colorado and the electricity prices that we face here in Denver, which are some of the highest in the country, and the rapid escalation and just shoving wind and solar into the grid. I mean, Colorado has a plan to get rid of all coal-fired power generation, which is it's a third of our power right now coming on these light bulbs and powering this podcast right now. A third of it's coming from coal-fired power generation, which is this dispatchable, baseload power, and that's all going to go away by 2031. So in less than 5 years, all of it goes away.
Yep.
with no replacement. And so part of this is there's been so much wind and solar that's been shoved in the grid. It hasn't actually, it's cost the consumer a lot of money. And so these things make me think of like, look, the world is already addressing this, right? Because I hear a lot when people say I'm building X thing in Colorado and Excel's not there. They have to come to like an LPI or something, right? To say, hey, we need this power. Is that something where the average person, or there can be an offset where, you know, when the public utilities are not responding and they're not responding to the consumer, that there's going to be an industry that comes like and I'm not saying it's all LPI, but industries that come around and say, yep, you want, you know, this power to your house or whatever, and you want a chance to power it by natural gas as opposed to this intermittent sources, that this is going to be a real thing?
That's a good question. I mean, quite literally, 2 days ago, we announced a partnership here in Colorado to power the Colorado Air and Spaceport, potentially up to 45 megawatts of power, because
that's awesome.
They need power from someplace else. It's not coming from the grid. And so, yes, it's happening right here in Colorado. We are feeling the real effects of energy policy decisions that are being made here in our ability to develop or maybe not have industry develop here. And to your point, we have consumers who are feeling it in the pocketbook. We have seen energy prices climb here at much faster than the rate of inflation. And I think people argue about why, but I think you can make a pretty clear case as to why that's playing out. I think that we're going to see the grid evolve with time. This hasn't happened yet, but we had a conversation maybe 18 months, maybe a little more than that ago, with one of the major grid operators. And it was a conversation around exactly how we were thinking about power generation, which is this smaller, more nimble, modular approach. Of course, that's not how power generation has been done up to this point in time. You build a hundreds of megawatt or gigawatt scale facility, and then you build transmission to get that power wherever it is required. And that works great as long as you can build infrastructure. But when we run into a problem of not in my backyard, and not in my backyard certainly affected our industry, but it's affected others just as much. Whether that's a transmission line or a wind farm or a solar farm, everybody feels the not in my backyard thing. We have the ability to be quite surgical in our approach to power generation. We could put 50 megawatts of power generation in just a few acres. Doesn't take up much space at all. And so you have this ability to go quite literally substation by substation by substation and surgically insert megawatts there to meet demand of a very local area, rather than having to upgrade an entire transmission system to drive that. And so, while I don't think that we've gotten there just yet, I could certainly see a world down the road where it's not all of the growth in power generation, but some amount of that growth is coming through this more surgical approach, where we bring 10, 20, 30, 40, 50 megawatts to a very specific location, to a substation, and without having to upgrade any transmission there, can boost the amount of power available in that industrial neighborhood, or in this case for a very specific industrial development site. So I do think we're going to get there. I think small modular power is going to play a real role in resilience of the grid and the electrification of everything if we continue to head down that road. But it's early days in that today. I think we're a bit ahead of a recognition that this could be a great piece of the puzzle. They're very, very efficient assets. They can operate in an environment where you have stringent emissions requirements. It can be done very quietly without disturbing the neighbors. It's not like putting up a power plant.
Right.
And most people wouldn't even know it was a power plant sitting there.
That's incredible.
So I do think that will come to look a little different, but we'll see. Early days on that today.
No, but that's great to think about. So, okay, so lastly, and let's close on this.
All right.
We didn't spend enough time on this. Okay, just the state of the frac. You know, the frac world. You know, you talk about being 20% of the market. You guys are the second largest, frac company in North America. I often don't think that the stock market talks about you as enough as they should. I think you should be on CNBC and Bloomberg a little bit more, and maybe I can get on there and talk about you guys. But I mean, the market needs to probably talk about you guys more because the role you have and just the quality of the company. But when we talk about electric frac fleets, and you just mentioned this, electrifying everything, right? Which is really, it's natural gas, right?
Yes.
And so that makes it easier, I think, a lot for folks to understand. But so So your Digi, like you have all these different Digi Prime and Digi and everything. So you have, and you dual fuel, and you have the ability to, switch off on things. And we have, I think you mentioned this in your last earnings call where you did get really nerdy on numbers, which was awesome, and efficiencies and fuel. But you were talking about, getting rid of some of the older fleets that, for not you guys necessarily, but other things that have to be retired, and then the newer ones. And so where's the sort of the state of where you guys are at? And I don't know if you can give us a number for how many are electric or Digi, but what is Digi? What is Digi Prime? Where does it stand? I know you guys have been, you were leaders in Colorado on the quiet frac fleet, which was awesome. Lots of folks now have quiet frac fleets, but you guys definitely started that revolution, which is really cool. And now you've sort of also been leaders in this Digi or electric frac fleet space.
Yes. So today, the industry rapidly moving towards only consuming or only running fleets that consume at least some amount of natural gas.
Okay.
So if you back up to when Liberty started, fleets were primarily run on diesel fuel. I think it was our second or third fleet. We built our first dual fuel fleet, which allowed us to displace some amount of the diesel with natural gas. And that technology's continued to evolve, and ultimately we get to a place where somebody says, why not 100% natural gas? The initial approach to that, as I said, was electrification. Use gas to generate electricity, use power to drive a pump. We've since evolved that to include a direct drive solution where a natural gas engine drives transmission, drives pump. And we don't have that additional conversion of energy into electricity back to mechanical energy when we lose some. This solution of a direct drive is a mechanical drive system, far more efficient. We had some technological hurdles to get over there. Roy probably got pretty nerdy about that stuff, but we ultimately did. And today, we're proud to say that I think we were the innovators in this direct drive gas solution, and it's now being talked about by others in our space. They're recognizing it as a path to accomplishing consumption of natural gas in a more capitally efficient way. It takes less money to ultimately build one of these pumps than it does a generator plus an electric pump. And so for us, as we think about the capital investment to transition our whole fleet over to something that primarily consumes natural gas, doing so in the most cost-effective way is valuable for us, maximizing return on invested capital. And so we will build primarily what we call Digi Prime, which is the direct drive solution going forward. The only reason you'll get an electric pump from us now is if you say to us, Liberty, we're going to build a microgrid and we want that grid to supply some or all of the power to run the frac fleet. So we want you to consume electricity on location. We're going to generate that elsewhere. In that case, you get an electric pump. If your only ask is to burn natural gas, then Digi Prime is the right asset to do that. That offers us the best way to accomplish that, and quite honestly, in a denser footprint on location than we can accomplish with the electric one. What that's meant now is that today in Liberty's world, it's about little north of 90% of our fleet now burns gas in some way, shape, or form. At the low end, dual fuel; at the very high end, 100% natural gas. And it's about 25% of our fleet today that is 100% natural gas, that is Digi in some way, shape, or form.
And then the other good chunk is a lot of is dual fuel.
Either Tier 4 DGB, the most advanced version, that's displaces about 75% of the diesel with natural gas. Tier 2 being the earlier form of that, substitutions maybe 55 or 60% on that. So those are really the three steps that we kind of have across our gas burning fleet today.
That's awesome. And you mentioned actually the efficiencies and the lack of maintenance on these fleets, which I thought is a huge thing. And I thought, gosh, are these? Some analysts can ask these questions of that's a big one, right? Is that you're not having to, the way I understand it, you're not having to work on them as much. They don't require nearly as much maintenance. And that's got to be huge just from a efficient standpoint for running out long duration. I mean, obviously you need to kind of work out the kinks of when you need to refresh it and everything, but that's got to be huge.
It really is. So if you think about a diesel engine, diesel's certainly a dirtier fuel to burn, and the combustion process is a little different than it is for natural gas, but there are implications for that. We have worked very, very hard to get the time between major overhauls on our diesel engines up to 25,000 hours. Right out of the factory, the manufacturer of the natural gas engines uses 84,000 hours as time between major overhauls, more than 3x what we accomplish with a diesel engine. I don't know if we'll get that long. Our operating environment on a frac location much harsher than their typical operating environment for a generator. So maybe it's only 60 or 70,000 hours for us, but it's still a massive change, and we have less of them. You know, we typically run a dual fuel engine if we're aiming to maximize substitution at, I don't know, maybe 1,800 or 1,900 horsepower out of that. These natural gas engines, depends on the manufacturer, but on one of our pumps it's about 2,900 horsepower at the pump. On the other one it's about 3,200 horsepower at the pump. So we replace 1.8 of these with one of these. Yep. Not only does the engine last much longer, but we only have one of them instead of two of these. Right. And so when you start to think about that from a capitalized maintenance standpoint, our asset base is going to get meaningfully smaller for the same amount of work, and we're going to have to work on it a half to a third as often. That's phenomenal when we start to think about what it means to execute at the level we do now and the cost to do that. Even the size of the support operation that we need to maintain that. These things all start to look different. And again, as we think about being economically competitive over the long run, ensuring North American barrels can compete on the global stage with other barrels, every one of these incremental steps is a little piece of the puzzle that contributes to that success. That's
incredible. So Ron, I've kept you way longer than you probably wanted to be kept. I have to ask one last.
All right.
Because we forgot to, and I'm a PetroNerd, and clearly you fit in just fine in the PetroNerd community. Okay, so you're just talking about the efficiencies and this capital, all this stuff of this. We're pumping. So this is 100 mesh, and I asked Ron to bring this on because I forgot my own. This is pretty clean 100 mesh looking sand.
Yep.
Largely what we're doing, and we had evolved from 4070, Northern White that was coming from the Midwest, and now we're doing lots of local stuff. And I encourage you guys to listen to our earnings call because you guys talk about even doing more wet stuff, a slurry pipe, all kinds of stuff. But how much of this powder, like almost dust, are we pumping, per lateral foot right now?
So we're pumping probably 2,200 pounds per lateral foot into an average unconventional well today. Varies basin by basin, but it's a lot.
It's a lot. And as we, in theory, so, and I hear some people do 3,000, and it's interesting because, back in the day when we would pull back in price, people would often pull back in completions.
Sure.
And so it's kind of been the opposite since COVID. It's like, well, if I'm going to put the money into it, I'm going to actually maximize that completion. And so I think that's just incredible to think about as a company, all the logistics and everything, but also the wear and tear on your stuff. When you're pumping this powder in 2,200 pounds per lateral foot, just from a technical standpoint of thinking what's happening within the rock, it's a really phenomenal operation.
It really is. But again, to the point of making sure the industry remains competitive, you think about, we used to source Northern White sand.
Exactly.
That we mined that up in maybe Wisconsin. We loaded that on a rail car. We hauled that rail car to a transload facility near the well. We put it in a silo. We dumped it out of there into a truck, and then we hauled it to the well site. All of those things add cost. Now, we're able to, given the evolution in completion design, use a material with much lower conductivity, still accomplish the same deliverability out of the well, and do so as a result using material sourced much, much closer to the well. Started with still more conventional mines where we mine the sand, we wash it, and then we dry it, and we put it in a silo and load it in a truck. Now you mentioned damp sand, these proximity mines where the closest we have done work is a well site 750 feet from a mine. The sand never even gets in a truck. It comes out of the mine, out of the wash plant, goes on a conveyor belt, goes over there to the blender, gets dumped in a blender and pumped down hole.
That's incredible.
If you think about what that's meant for the cost of the sand, which represents probably 50% of the cost of a frac job, what that's meant for the cost of that material going into the well and the resultant economics, it's phenomenal.
It's huge. And it's just also impressive because also to the point we were talking about at the beginning of what you have talked about in your earnings calls is, hey, we will have to evolve, right? As the acreage evolves, as the industry evolves, as we have more consolidation, and then you have the private, different evolutions of the industry. If you get to that point where you have higher oil prices and it's the lesser acreage, you probably will be pumping more sand, right, to get more from the rock.
Yes.
And so it's a business that's it's really cool and it's never going to end. And you just thank you. That's a great explanation.
I love it. Never a boring day here, and as I've said, I never bet against our industry. We're constantly innovating, and who knows what the future will hold.
Absolutely. Well, Ron, I have to say, you have CEO of Liberty Energy, Ron Gusek. You have been a phenomenal guest and one of my absolute. You're absolutely one of my top guests, bar none.
Well, thanks for having me on. I appreciate it. It was fun.
Thank you.